Bond yields making headlines today. I'm Lisa Bernhard with Reuters, and I'm joined by George Cipolloni of Penn Mutual Asset Management. George, maybe it's not the sexiest headline ever, but it's all over the place today that the yield on the 10-year Treasury hit 5% for the first time in 16 years. What is driving that yield so high, and why is it significant?
Yeah, Lisa, the 5% level is a huge psychological level, and many did not expect it to reach this point. But so if you look at the characteristics that are driving some of the demand, or actually the lack of demand for bonds, number one, there's a huge supply of bonds that are going to be issued over the next few years. A big driver of that is because of the huge deficits that the U.S. faces today. It's up to 1.7 trillion in terms of the deficit this year. And then large deficits beget larger and larger amounts of interest income interest costs that we're going to have to face as a nation. And so that's been the spiral that we've been faced with. It's really surprising that bonds haven't found, more of an anchor. They did find a little bit of one today, but because usually bonds are a flight to safety asset, but they haven't been that. And they've actually been the cause of a lot of volatility that we've seen in the stock market. And today is a perfect example.
But George, a lot of average people have heard from people like you that this is a time when they should be buying bonds, given that it's a fairly rare moment in their lifetime where bond yields are high. And yet they're hearing about a sell-off when they're also hearing that they should be buying. So make sense of that for people who find the two hard to put together.
Yeah, it's that contrarian element that we think is really important with investing. You tend to want to buy when prices are low. And I think a lot of, most people don't realize that bonds have faced roughly, 150-year losses, which is just absolutely unprecedented and historic. And we faced a 4 standard deviation up move in yield. And so that's creating an environment where, from a value standpoint, bonds look more attractive today than they've looked in a very, very long time. Real rates, even further, real rates, adjusting for inflation, are positive for the first time in a long time. And so that's creating an environment where investors should start to look at bonds. Now, again, we're going to get some volatility because the fiscal situation is different than it's been in a very, very long time. Central banks are backing off away from QE to QT. So there's these inherent dynamics in at least the government bond markets, and that's one thing to keep in mind. I will say, in the corporate bond market, if you can find really good companies with great balance sheets, now is a really good time to try to latch onto those yields and secure them for a long period of time.
Also making news today is Chevron agreeing to buy Hess for $53 billion in stock. This comes on the heels of Exxon agreeing to buy Pioneer Natural Resources. What is driving these deals among oil companies, and will we see more of this?
I think we will. So for a few reasons. Number one, it's really hard to get growth on an organic level at this point in time. So what we're going to see is a shift from organic growth to more acquired growth. That's one factor. The other factor is some of these, if you think about Pioneer in particular, Sheffield, their CEO, he's been around a long time. He's in his 70s. It was a really good time for him to sell his company that he's built over a long period of time. So a few of those things are lining up. And then one other thing, and not to make it a negative spin, but usually when you head into a situation where you foresee tough economic growth conditions, you tend to see more deals happen at this point because some sellers are willing to sell now, where maybe a few years ago, if there was a great growth outlook, they wouldn't have been willing to. So I think we're finding a happy medium now between some buyers and sellers at the moment.
Also, this week, we will see earnings reports from at least 4 of the Magnificent Seven that, as we know, have been largely driving the stock market this year. We have tomorrow, I believe, we have Microsoft and we have Alphabet. We have Meta Platforms this week. We have Amazon this week. What will investors be looking for, both collectively and individually, with some of these companies as they report?
Yeah, Lisa, one of the most interesting things is that even though we've heard a lot of negative news and we've seen some negative reactions in the stock market, one of the things that's interesting is that expectations are actually up, and EPS estimates keep going up for whatever reason. Now, specific to the Magnificent Seven, their PE has gone up a lot this year, and it's gone from 29 times at the beginning of the year to 46 times now. So again, that also speaks to the inherent underlying growth expectations for these companies. So I think that's what the market needs to see. Now, if you look at, I think it's going to be choppy, but Netflix posted really good growth results. I mean, they turned in a 20% plus number, and you saw what the stock did. It still did well. And within the Magnificent Seven, you see NVIDIA's growth expectations are really high. Microsoft's are really high. Google's around 37%. And if you take those out, though, there's not a lot of growth left in the other areas of the market. So they do need to deliver. I think it's even more important that these seven deliver at this moment in time. Otherwise, again, you have some pretty potentially big gaps down in terms of valuation.